Now to focus on the fundamentals behind the technicals, we've got Phil Streible joining us, Chief Market Strategist at Blue Line Futures. Phil, am I right? First of all, welcome. Am I right to argue that the dollar, the 10-year yield, a reflection of the Fed at this point? Are they both? They seem to be kind of looking for direction pretty clearly in a holding pattern here.
Yeah, it looks like there's a lot of complacency in the market at the moment. We are at about a 6-day high on the dollar index right now, but it doesn't feel like it's going to break out to the upside. 10-year yields, the line in the sand for me, 4.3%. On the 30-year, it's going to be 4.47%. We don't want to see a break above those levels. Now, the economic data clearly impacts yields. Yields impact the dollar index. The stronger dollar hurts a lot of these different commodities. So with the dollar index up about 0.25% here this morning, putting a little bit of pressure on the markets, but we're seeing things like the gold market kind of trickling right back up here, stuck between the 50 and the 200-day moving average. So we'll see what happens. We expect a small upward revision on GDP here, about 3.4%, the consensus 3.3%. And then we are going to have those two Fed speakers, the FOMC voters that we're going to watch here today, Atlanta Fed President Bostic, and then also Fed President Williams. But they're not giving us anything new. The commentary is like so dry and just so plain. They're all waiting.
No shock, basically, is how we put it in the last block.
Phil, we're not getting anything like that December meeting where, and then Powell reversing course. It's just not happening right now.
Talk to me about the dollar again at this 104 level. Yeah, it's higher. It's up about 0.25%, but still relatively contained. You mentioned how it hurts commodities. I'd argue continued strength and a move up through 105 could hurt stock bulls, right? We've been arguing for a while that the activity we've seen conducive to that run-up we've seen to these historic levels in the indices, but in that category of some of the supporting contributing factors, you've got the dollar, you've got crude, and for that matter, gold's a reflection thereof in terms of some of those geopolitical concerns contained at 2050. I mean, all of these markets very supportive of what we've seen as far as stocks.
Yeah, historically, when the dollar tops or bottoms, that marks turning points in the stock indices, but stock indices have really kind of disconnected themselves. I do believe that this rally in stock indices is broadening out. I mean, people will argue that left and right because they'll say that the Russell is like 20% below its all-time highs. But I mean, you got to kind of look at where we're at right now. You can't always go back to, where we've been so far back because the dynamics were completely different at certain periods of time. So I do like the underlying narrative, and people are chasing a lot of different stocks here. There are the 4 or 5 that are controlling everything, but it seems like each one has its own little story to tell. Now,
Absolutely.
I know that when we talk about like NVIDIA moving $100 in a day, Palo Alto moving $50, that super microcomputer going up a couple hundred, those tend to mark some kind of tops or a capitulation point in the market here, but it seems to be very resilient at the moment.
Yeah, I'd agree. Sustainability with those names come into question when you see a big move like that. But also, each stock does tell its own story or has its own story in many ways, right? Talk to me, and kind of getting back to the currencies discussion here. Speaking of having its own story, the Bank of Japan, I kind of feel like we haven't really gotten anything definitive from them one way or the other, and that could tip the scales for the dollar, ultimately provide a little bit of clarity there. But even recently, what was it? It looks like slightly firmer than expected January CPI, the core rate at 2%, targeted, ultimately kind of renewed speculation for BOJ hikes, but there's still some uncertainty there.
The BOJ, that's going to be, Japanese yen, that's going to be the one to go long. Once they start cutting rates in the U.S. or we start getting dovish and the reality of the snowball effect, you're going to see a big short covering rally in the Japanese yen. So that's definitely one you want to keep on the radar. Look at those farther out option contracts, things like that. Because of the complacency in that market and the downward trend, there's not a lot of premium in those options, but the delta could be a quick vortex once it gets underway. So it's on my shopping list. It should be on everyone's shopping list to look at the yen to the upside, but it's going to take a more dovish Fed over here and those actual interest rate cuts in order to get that going.
Yeah, here's a look at the yen. It has been struggling to say the least here. This is just going back to the summer of last year. We were up around 73, 74. You can see the failed attempt here as we rallied back into the end of last year, beginning of this year, up to 7,200. We've come right back down to those lows from November of last year. Take a look here. A little bit of a longer term chart here really speaks to the significance associated with these lows. Take those out here, and we could see some further energy. Look at this on a weekly basis here. Looks like, wow, down almost what is this? It looks like 9 weeks in a row here or something, almost 10 weeks in a row as we've continued that slide. Talk to me a little bit about some of these Fed cut rate expectations. We were joking around in the office earlier this morning before the show. I feel like I'm looking back to December of last year, and there was something like a 90% chance, 90% plus chance that we were going to get a cut this March here. Now there's basically no chance thereof. I mean, I feel like that Fed tool, that Fed funds, the watch tool that we have, ultimately, what is it really a predictor thereof? I mean, if we get so hyped up about 90% chance and all of a sudden it falls off into basically zero expectation thereof.
Yeah, the devil's going to be in the details on that one. So as that sentiment shifts, we see that start to come out. Maybe the CME will make that a tradable product there where you can short
Love that.
97% or go long with those expectations. So 16.5% chance right now that they'll cut in the May meeting. It's like a 0% chance in March. And then if you go out to June, it's a 64.5% chance that they'll cut. But you got to see this weaker economic data, and the economy's been really quite firm, at least in my opinion, and what I see around here. We've been traveling all over the place. My team's in Houston right now. We were in Las Vegas last week, and it was just rocking. I mean, people are just spending money left and right. Maybe they don't have it. Maybe they're taking on credit card debt and things like that, but it just doesn't seem like the economy's been derailed whatsoever. And I think that we're kind of at this new time. You know, the one thing where this conversation is all about currencies and interest rates and things like that. And I look at Bitcoin up 6% here today. And you know, you ask yourself, what kind of currency moves 6% in a day? We don't live in like Argentina or, you know, some South American country where you see that type of volatility there. So I really don't think that Bitcoin is really a currency. It's more of this commodity, if anything.
Yeah, it's kind of one of the more sized moves we've seen since the ETF approval. Ultimately, there had been kind of a reduction, I felt like, in the volatility. Today's move definitely stands out here, but also you can tie it into kind of that risk on, that optimism abound, also the ETF sort of backdrop adding to it. Appreciate you joining us here, Phil. Thanks for covering currencies and treasuries with us here this morning on the Futures Show. Phil Streible, Chief Market Strategist at Blue Line Futures.